Normally, I'm talking about exits and what comes next for business owners. But today, I'm taking a quick departure to cover the tax changes in the One Big Beautiful Bill. Changes you'll want to be ready for when they take effect in 2026. I'm joined by Rachel Kramarchuk from Carson Wealth to break down what's permanent, what's new, what's temporary, and most importantly, what business owners can be doing now to plan ahead. Rachel, thanks so much for being here today. Rachel, you're from Carson Wealth in the Highlands Ranch office, and we are talking about the One Big Beautiful Bill today and the implications of the taxes from that bill on business owners. And I just want to kick this conversation off with why I'm talking to you, wealth advisor, about the One Big Beautiful Bill versus a CPA. Now, I could have this conversation with a CPA as well, but I think it's really great. What I've seen or what I've witnessed from Carson Wealth and your office is the investment strategy piece, but also all the things around it too. Policy, what to do next. You're really a well-rounded advisory office. And so I wanted to have this conversation with you today about the One Big Beautiful Bill and the implications for people. But that's my impetus. Just talk a little bit about how you guys navigate tech strategy in general, and how you work with and differentiate from CPAs.
Yeah. Thank you so much, Cindy. I'm excited to be here. So the way we see it, Carson has had a very big focus on tax. We see ourselves as, an advisor to the individual or business owner, and we dabble in a lot of things to help surround the business owner. We help them have a whole comprehensive plan. We review their estate plan. We review their taxes every year. And every year that we focus on the business as well. So we're surrounding the business owner, collaborating with the professionals that support them. And for taxes in particular, you this is not a hard and fast rule, but a lot of CPAs are focused on filing taxes correctly, making sure you're complying with the IRS rules, record keeping, and they're looking at that particular year, especially if you just meet with them after the year is done. You hand them all your stuff, and then they file your taxes. And that's not all CPAs, but a lot of them, that's the relationship that they are able to have with their clients. And we meet with our clients more frequently. They call us if something is going on in the year. So we're looking forward and trying to find opportunities for our clients. And I mean, from a financial advisor's perspective, the goal is to work collaboratively with your CPA to make sure you pay the lowest amount of lifetime taxes. That might mean paying more taxes this year because it's a lower income year, or there's a good reason to pay more taxes this year. But the whole goal is to make sure over your lifetime you pay the least amount of taxes possible.
Love that. I love the lifetime aspect of that too, right? Like really looking long term, not just 1 or 2 years ahead. And to your point, some clients might be limited, or some CPAs might be limited to their clients' use of them as well, but that's great. Okay, so let's dive in. I think unless you have not watched any news, if you're on a media fast or living under a rock, you've heard about the One Big Beautiful Bill. But specifically, want to break down the implications, and you've got a great way to talk about it. So, like, sort of what's continuing, what's sunsetting, what's coming. So let's dive into just a quick overview of the One Big Beautiful Bill from your standpoint as we look forward on business owners and tax strategy.
Yeah. I think it's really important for business owners to pay attention right now because, before, for many years, we've been just wondering what was going to happen. The tax laws, we knew it was set to sunset at the end of this year. So there's so many areas where we were holding off on taking action or just unsure of what the future would look like. And now we have some clarity. With the One Big Beautiful Bill Act, some of the provisions from the 2017 Trump tax cuts have been made permanent. So we could talk about those. And then there's some areas that are new and were just introduced or were major changes. And then there's some temporary provisions that it's important to take a look at, to see if you could take advantage of them before they expire.
Yeah.
And many of the provisions in the One Big Beautiful Bill Act are starting in 2026. So this gives us an opportunity to do some planning ahead of time.
So let's start with the extended and permanent laws from the One Big Beautiful Bill.
Yes. So in 2020, we had the TCJA, which were the original Trump tax cuts. And those provisions were set to sunset at the end of this year. And so a few of those that I'm going to highlight that we think will be important to business owners in particular, both personally and in their business. One of those is the individual tax rates. Those were lowered in 2017. Most people were paying higher tax rates before 2017 than they are now, and those have been made permanent. And then another one is the qualified business income deduction. And this is for pass-through entities. They get 20% deduction on qualified business income. And this was started because in 2017, corporations had their tax rates cut from 35% to 21%. And so this leveled the playing field and allowed a deduction for pass-through entities like individual businesses and S corps.
Okay.
And so the income from the business passes through to their individual return, and that's what makes them a pass-through.
Yeah. So solopreneurs, LLCs, S corps, all get the same benefit of a tax that the corporate tax was getting, or similar.
Well,
Again,
yeah, they get a deduction to kind of help with that. The corporations were getting a
yeah.
lower tax
Let's be
rate.
clear. Deduction. Don't listen to me. Listen to Rachel.
And then another area that's been extended from the 2017 tax breaks were the estate and gift tax exemptions. Previously was anything under $7 million to avoid the estate tax. And now it's been permanently raised to an inflation indexed 15 million if you're single and 30 million for a couple. For most of us, that won't come into effect, but for somebody that's selling a business, or that will help them to be able to pass more of that income without triggering an estate tax. And then the
Great.
final one I wanted to touch on that's been extended is opportunity zones. This is a tax strategy or tax incentive for people to invest in distressed areas in the US. And it was set to sunset at the end of 2026, actually. Most were sunsetting at the end of 2025, but that was going to end at 2026. And that's been extended, so it should offer investors more options.
Now that's been extended, or okay, so not permanent, but extended. Okay.
Sorry, yes, it's permanent.
Oh, it's permanent. Okay, great. Good distinction. All right, good. And then on the opportunity zones, we've talked about this before, just off the interview, about how this can be a really great exit strategy. So before we go into sort of the next part of what's coming on the Big Beautiful Bill, talk a little bit about how a business owner can use opportunity zones as an exit strategy in protecting their money, investing their money that they earn from the sale.
Yeah, of course. And the business owners, their income is tied up in the business,
Mhm.
and so it's important when they're selling to try to keep as much of the proceeds as possible, because this is funding their retirement, their
Yeah,
legacy, and the goals that they have for the future. So it's important to explore many different tax strategies. Opportunity zones are one to consider. I can give you a very basic example of a business owner using it in their
that'd be
exit
great.
plan.
Yeah.
So if an owner sells their business for $3 million, they are able to defer the capital gains tax on that sale for 5 years if they roll it over into an opportunity zone. They could purchase a business or a building in one of these distressed areas in the US, or they could invest in an opportunity zone fund that invests in those areas. But if they roll that money into an opportunity zone fund or building, then they can defer the capital gains from the business sale for 5 years. So they're able to earn money on that, earn interest on that money before they have to pay those taxes. And then let's say that $3 million invested in the Opportunity Zone Fund grows to be $6 million. That extra $3 million of gain, they can pull out after 10 years completely tax free.
Love
So
those words.
it's Sounds like a really great opportunity. It's definitely something to consider. It's not for everyone. You have to be comfortable with real estate investments, of course, have a risk tolerance that includes that. And also, you have to have a long time horizon. To get that benefit, you have to keep the money in that opportunity zone for 10 years. So,
Right.
a lot of times I think of it as somebody that's selling a business early. Maybe they sold to a PE firm partially. They're staying on, they're still going to get a paycheck, but they're earmarking this money for the future. So they won't need to touch it for 10 years.
That's
But
great.
yeah, it definitely has to be somebody with that type of time horizon.
Right, right. So it's a portfolio feature, not maybe not the whole thing, right? Talk a little, were there minimums, and also how do people find opportunity zones? Do they go through you like an advisor? Do they find these directly? Give a little more detail about how they
Yeah,
might do
and
that.
there's government websites that will tell you what zones are designated opportunity zone funds. So you can do your own research on that. Um, if you go with a fund, like Carson has funds available,
Mhm.
then you don't have to do all the research yourself, and you can. The minimum differs based on
Got it.
the fund,
Okay.
but it diversifies you further. So if you were to go out and purchase a property in Puerto Rico, that would qualify, but you'd have to do all the reporting yourself, and you'd
Mhm.
have to be invested all in one place. And so if you're investing in a fund, they're going to be broader, invested in different areas, maybe some rural, maybe some urban, and then they're going to do the reporting and research due diligence for you.
That's a good point. Like if you're not into the paperwork and the due diligence, a fund would maybe be a better option, right? Yeah. Or don't have somebody doing it for you.
It's a quicker to have it, and a discussion to have. There's
Yeah.
many different tax efficient investment strategies if you're exiting your business, but it could definitely be one to bring up and explore.
Okay, so let's go back to the one big beautiful bill. We talked about what's getting extended and what's made permanent. So talk about what's new and what business owners would need to think about.
One is there's now a 1% tax on money transfers abroad.
Mm.
That wasn't there before. So if you're doing business internationally, that's something to pay attention to. And obviously, this administration is trying to have more happen in the US. So they
Mhm.
added a 1% tax on money transfers abroad, regardless of if you're a US citizen or not a US citizen.
And that's both
Um,
directions, in and out of the country.
y- yes, yeah. And then another impactful one is, and it's not exactly new, but I thought of it as it's a change from what has been happening. Actually reverts back to pre 2022, but for the past few years, interest expense deduction has been calculated based on EBIT, which is earnings before interest and tax.
Yeah.
But now it's been expanded, and it's calculated based on EBITDA, which is earnings before interest, tax, depreciation, and amortization. And
Mhm.
so, really, what this means is you're able to deduct a larger portion of the interest expense. So, this is going to be impactful for high capital industries like
Mhm.
manufacturing, and it'll improve after tax cash flow and maybe make investments for more viable. And I know a lot of your listeners are business owners planning for exiting. So why I
Mhm.
think this is impactful, being able to deduct more interest if the business owner is 5 years away from exiting their business or 10 years away from exiting their business, they might want to make sure that they can grow the business to a point where when they exit, that's going to fund their lifestyle after exiting. So being able to grow that business and make more investments and deduct more will be better for them.
Yeah. And I always just am a proponent of planning early. I know you and I talk about that. So I love that you mentioned 5 and 10 years ahead, even if you're thinking about it that far in advance, like just starting to prepare. And then even talking with, again, an advisor who's also looking at that kind of horizon, like those kinds of things, those kinds of decisions can be discussed at that point in time, right?
Yeah,
Yeah.
yeah, it's
That's good.
good to have facts when you're looking to make decisions. And so the
Right.
earlier you can know what you need, the better you'll be
Yeah.
to decide,
Yeah.
oh,
Yeah.
am I going to grow this business or am I ready to exit tomorrow? Because I think
Right.
a lot of business owners I talk to are kind of on the fence. They're like, could I could be here 10 years or something might make me want to get out tomorrow. So
Right. I
you
know
have
it
the
is.
options.
Yeah, I think it's a teeter-totter for everybody right now,
Yeah.
right? Like, yes, no. And then as far as did that cover everything for the new and
Yes,
significant
yeah, I
changes?
just thought of a couple of things that are new, but then were impactful to business owners in particular.
Okay, perfect. And then there's a third category, and these are some new temporary tax items that have come up. So walk us through those.
Well, the first one was really what Trump campaigned on. He was able to get a deduction for workers for tips and overtime. So workers that are earning less than 150,000, there's phase outs of about that range, but workers earning less than 150,000 will be able to deduct up to $25,000 in tips, and then in overtime they can deduct 12,500 for individuals and $25,000 for couples. But this is both of those are set to expire at the end of 2028.
Okay. So we do have some temporary ones in
Yes, yeah,
there now too. Yeah.
yeah. So
Okay.
take advantage of it while you can.
Yeah. No kidding. No kidding.
But I thought that was impactful, not in particular for business owners, but for business owners, so they know for their employees, especially if they're in restaurants or industries where they get tips and then
Yeah.
overtime as well. The other one has been called the bonus depreciation, and I really don't like the name because it's kind of confusing. At first, I was wondering if you give your employee bonuses, are you able to depreciate that? But it's just it's a 100% depreciation on the cost of qualified property. And this is like most equipment and machinery. So, again, for those intensive um, industries like manufacturing.
Mm-hmm.
Uh, but the temporary aspect of it, it has to be acquired after January 19th of 2025 and
Okay.
placed in service before January 1st of 2030. So there's a window in order to get that 100% right away deduction.
Okay.
And then there is one more that I wanted to talk about in the temporary aspect, and this is the salt deduction cap. So in 2017, most of the provisions benefited tax bills. There was one that made it a little bit more difficult for individuals, especially for individuals in high tax states like California. The SALT is state and local taxes, such as the taxes you pay on your property. And they capped it in 2017 at $10,000. So even if you spent more in taxes on your state taxes and your local taxes, you are only able to deduct 10,000 from your federal taxes. They've increased it to 40,000, and that's for single and for married filers, and with adjusted gross income below $500,000.
Okay.
Beginning in 2026, they're going to raise it 1% each year to account for inflation through 2029. But then in 2030, it's going to revert back to the $10,000 cap. So
Okay.
we'll see what happens with that. But as of now, it's set to revert back in 2030.
All right. So we have talked about what's sticking around, what's temporary, and what's new. It seems to me like, and I'm putting you on the spot here a little bit, like manufacturing certainly is a winner, to your point. That is what Trump campaigned on. So manufacturing getting some good breaks, but also some of the workers and the tips and whatnot. And then even some breaks for the gig economy, if you will, right? We've got more the solopreneur, the LLCs, the smaller companies as well. How would you recap? How do you feel about the bill as far as business owners?
I think overall it's beneficial for business owners. And I think,
Mhm.
like I said, kind of at the beginning, it's it's good that we have some clarity. The fact that
Okay.
for a few years we knew the tax code was going to sunset, but we didn't know what was going to happen really was difficult for planning.
Yeah.
We always try to model scenarios for our clients. We're trying to model the exits for our business owners and our financial planning systems, and we weren't working with real data if you didn't know what the taxes were going to be. So it's good to have some clarity. I think, and that the state and local tax deduction, increasing the cap, was a way for the Republicans to also have the Democrats benefit so that they could get this passed, obviously.
Yeah. Yeah. Yeah.
And so, because a lot of um, Democrat heavy states are the higher tax states too, so
Mm.
that benefits them. So I think overall, most business owners are happy with these changes.
And it just sounds like really the big win here is the ability to plan. To your
Yes,
point, the clarity, the ability to plan, have some certainty at least till, till 2030 in some cases and beyond that in some others. So
yeah.
that's great. Now, I always have to sneak in one question. I know you work with a lot of business owners and you personally do a lot of exit planning with business owners. And that is the work that I do as well, not on the financial side, but on the personal side of preparing emotionally, psychologically, personally for what's next. And so just any thoughts that you have about any of the big beautiful one big beautiful bill implications on planning, but any implications you see, like if I'm selling in the next year or two, what's your recommendation to business owners?
If you're selling in the next year or two, I don't know if the One Big Beautiful Bill Act will have a huge impact on that. It it might make your your cash flow better, so you're able to some of the income deductions and expanded possibilities there
Yeah.
might make it so that you're able to maybe pull a little bit more out, diversify your portfolio a little bit, so that
Hmm.
it maybe everything's not invested in the business. I know business owners don't like to hear that because
Yeah.
they love investing in their business, but it's kind of hard to um, for some to invest other places, but
Yeah.
diversification is always a good thing.
Yeah. Yeah. Well, I love that there's even maybe a little bit more clarity and certainty on the financial aspect of what's next post sale as well, right? Like, it's always I think a anxiety inducing thing to sell your business, to retire, to rely. I mean, we're so used to earning income, earning income, earning income, and then to stop. And now you're divesting instead of
Yeah,
investing. It's always anxiety inducing. So if there's even the ability to plan there a little bit more based with some certainty or at least clarity to your point, that's helpful from a financial standpoint. Like that's certainly a large key of that planning, of the next 30, 40, 50 years, depending on how long you live, right?
definitely.
Yeah.
And if
Yeah.
you're 1 year out or 2 year out from exiting and you haven't had that conversation with your financial advisor, you definitely should. And with more clarity on what the taxes will look like, then they can have a plan in place for how to pull money out most tax efficiently and how much you're going to need in retirement and maybe
Yeah.
setting some asides in case of uncertainty and all that. So definitely once you're in that window of getting close to exiting, it's a very crucial time period and important to be involving your whole advisory team, including your financial advisor, CPA,
Yeah.
personal planner.
And your personal planner,
Yeah.
because
You
you
never
gotta know
know
what
what
you're
you're
spending your
going to
money
do.
on.
You know how much definitely.
Exactly. Yeah, to know what you need to have in retirement, you need to know what you wanna do, right?
Exactly.
Good. Rachel, thank you so much for being on, talking us through all the implications for business owners of the One Big Beautiful Bill and why, really, if you're talking to your financial advisor, it should go more than just investments. Hopefully, people are having these conversations with their advisors. And if not, they can talk to you at Carson Well. Thanks so much for being here.
Thank you, Cindy.